Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of May 5th. If it's your first time, thanks for joining us. If you're a return customer, thanks for coming back. And as always, if you find this video helpful or informative, make sure you take a minute to like and subscribe. Also, take just a minute to check out some of the other great content we have here on our page. So with that, my goal for these videos is to use my background in economics to help you better understand the economy and the financial markets. That way you can make informed financial decisions. So with that, let's get ready to hit the books and get up to speed on the markets. So as usual, we'll get started by taking a look back at last week. Last week was a huge economic data week. We had data on jobs, inflation, and gross domestic product. So we'll start with jobs, which was a bit of a mixed bag. I'll give you the tough information, then I'll give you the good information towards the end. So to begin with, we saw the number of job openings in the month of March drop by about 300,000. We saw indications that employers have continued their wait-and-see approach with low fire and low hire results in the JOLTS report. We also saw the ADP private employment report indicate 62,000 jobs were added in April, which was about half of the expected 120,000 jobs. Taking a look at the unemployment insurance program, we saw new initial claims increase by about 18,000 to a level of about 241,000, which is the highest level we've seen in the last 2 months. We also saw the continuing claims for those filing ongoing unemployment insurance claims increase by about 83,000 to the highest level since November of 2021. On a more positive note, we also saw the national unemployment report last week, which surprised both investors and analysts, coming in at about 177,000 jobs added, and the unemployment rate stayed at 4.2%. This level of job additions was more than most analysts expected. It was also more than the average of about 150,000 jobs that we've seen so far this year. We also saw some positive inflation data last week with a small caveat. So, the Personal Consumption Expenditures Price Index for the first quarter came in higher than expected, but on a month-over-month basis from February to March came in at practically 0%. And we also saw the 12-month inflation through the month of March drop from 2.7 to 2.3%. Both of those are incredibly positive signs, but as I said, there is a small caveat, and that's the fact that this data is for the month of March, so it doesn't include the majority of tariff actions that occurred on Liberation Day or the ongoing impact of the implementation of tariffs that occurred throughout the month of April and most likely will continue in the month of May and June and beyond. Now, like I said, last week we saw jobs, inflation, and GDP. So we received the first estimate for the first quarter of 2025 GDP. Unfortunately, it was worse than most analysts expected. The general economic and investment community had expected a slowing economy, but we actually saw a negative growth rate, meaning the economy contracted slightly. In fact, the first estimate was a negative 0.3% growth rate, meaning the economy contracted by about 0.3%. The majority of this effect was driven by imports, which are a negative contributing factor to the GDP. And the majority of those imports, from what we can tell, are companies and consumers preemptively purchasing imported goods moving their consumption forwards to try to preempt the Trump tariffs that were implemented in April. Over the next 2 months, we'll see ongoing revisions to this data, which will help enhance the accuracy. And those revisions will be incredibly important as we turn our eyes forward to the second quarter, which means April, May, and June, where we'll actually see a much bigger impact of the actual tariffs themselves. Switching over from the hard data to the soft data, we saw the Consumer Confidence Survey results published last week. Consumer expectations dropped to the lowest level in 13 years. The Consumer Confidence Index dropped for the 5th straight month and has actually now reached a level that we haven't seen since the COVID pandemic. Expectations for future income actually turned negative for the first time in 5 years. And the share of consumers who are expecting fewer jobs in the next 6 months increased to 32%, which is the highest level we've seen since the Great Recession in April of 2009. Despite the ongoing pessimism and concern in the soft data, like consumer sentiment and consumer confidence, we actually saw a relatively reassuring week of hard data results and relatively reassuring week of earnings reports. So switching our focus to the Q1 earnings reports, we saw Meta and Microsoft both beat on earnings and sales and expressed significant optimism about future AI development and cloud computing. We saw Amazon beat on earnings, but ultimately release a softer guidance for the second quarter of the year. And we saw Apple match expectations, but unfortunately experience a pretty significant drop in sales in China and express reasonable concerns about the impact of tariffs. Taking a look at some more consumer-facing earnings reports, we saw Coca-Cola and McDonald's both miss on sales and profitability, but both also offered relatively stable, although cautious, guidance for the rest of the year. Healthcare giant Eli Lilly actually beat on earnings and revenue, but issued a much softer, much weaker guidance for the rest of the year, and ultimately paid their price as the stock price fell more than 10% following the announcement. Meanwhile, credit card giants Visa and MasterCard both reported resilient consumer spending in the first quarter, although some of the spending categories shifted, such as spending on travel and vacation diminished, while spending on retail objects and retail organizations increased. Also, just to wrap up our first quarter earnings report for last week, we saw energy giants ExxonMobil and Chevron both report beats on earnings, but misses on revenue. Both incurred significant profit struggles as the price of oil dropped well below expectations. Turning our attention to the stock market, the markets were shaky throughout the week, but ultimately pulled off a win. The Dow Jones Industrial Average, S&P 500, and NASDAQ all posted gains by the end of the week of about 3%. There were a few shaky days and some down periods, but ultimately the markets recovered. The S&P 500 posted 5 additional gains in a row. Switching over to our fixed income side, the 10-year Treasury yield fell early on in the week, but then posted a pretty strong recovery towards the end of the week, ultimately ending the week higher than it began at a level of about 4.3%. Bitcoin actually posted a relatively stable week through Thursday, after which saw some significant gains, ultimately ending the week up about 3% and finishing with a value of approximately $97,000. Wrapping up with some of our usual alternative markets, the price of crude oil resumed its downward trend, ultimately losing approximately 8% throughout the week, in part as a result of the OPEC Plus discussions about increasing supply and production of oil over the summer. We also saw the US dollar lose some of its recent recovery, although it didn't move significantly throughout the week. Finally, the price of gold also fell throughout the week, ultimately ending below $3,300 and losing about 3% by the end of the week. As usual, now we'll switch our attention to this week and what's coming up. So this week, as far as first quarter 2025 earnings reports, we're expecting about 100 of the S&P 500 companies to report their results. Some of the headliners for this week are tech giants Palantir and AMD, as well as some consumer-facing companies including Walt Disney, Uber, Ford Motor Company, and Electronic Arts. Also this week, we'll see earnings reports from energy giants, Williams Companies, and ConocoPhillips, and we'll see reports from utility players, Duke Energy, Constellation, and American Electric Power. The big economic headline for this week is going to be the Federal Reserve making an interest rate decision around the middle of the week. The FOMC, Federal Open Market Committee, will be making their decision on Wednesday, and the chairperson, Jerome Powell, will be providing his speech to the public and to the media Wednesday afternoon. Ultimately, despite calls from the president and from some analysts and investors, the betting markets, the economist consensus, and the market consensus right now are all essentially in agreement that there will be no interest rate change at this meeting. There is ongoing discussion of 2, 3, and even 4 interest rate cuts throughout the remainder of the year, but confidence in most cases is above 90% at this point that there will be no interest rate reduction at the meeting this week. Some other important economic data that we'll see this week. We'll see the final trade balance numbers for the month of March. We'll see the report on consumer credit and overall credit balances. And we'll also see our regular weekly update on unemployment insurance claims. So looking ahead further out into the future, ultimately in the first quarter, we saw the gross domestic product contract a little bit. A lot of this being driven by additional imports in order to preempt some of the Trump tariffs. The second quarter, which will include the month of April, May, and June, will actually capture not just the concern or the fear of tariffs, but the actual economic impact of the tariffs themselves. Also interesting, and one of the points that we'll continue to watch, is that the 90-day pause that's been put in place for the Liberation Day tariffs will actually end around the end of the second quarter, meaning that it's possible that between now and then we could see significant trade deals and some of the concern about economic slowdown may be reduced. Or we could come out of the 90-day pause with far fewer trade deals than we had hoped. The Liberation Day tariffs are put back in place, and as we move into the third quarter of the year, we see the effect of the tariffs exacerbated. We know there's a lot of pessimism and fear right now in the economy. Unfortunately, this is what uncertainty brings. Uncertainty about the economy, about future recessions, about economic policy. It just leaves everybody on edge, waiting to see what's going to happen. Ultimately, we hope that what we can do for you, our viewers, is we can bring you the most helpful and the most important information in a way that's easy to understand to help keep you informed about the markets and the economy. To that extent, we do our best to help you stay up to speed on what's going on. With that said, I'd like to encourage you to focus on something optimistic this week. As we move forwards, uncertainty ultimately hinges and draws out a lot of fear, but uncertainty doesn't mean bad outcomes. It's possible that an uncertain environment can actually end up better than expected. So as we move forwards, I think it's beneficial for all of our mental healths and maybe even for the economy if we try to find just a little bit of optimism where we can. With that said, thank you for joining us this week. Good luck with the rest of your week, and we'll see you in next week's video.